My name is Charles Gershom, and I want to take you through financial accounting, just like we did last time. It's a continuation of what we did last time. And today, we want to learn about final accounts. Before we learn about final accounts, let us just go through what we covered last time. Last time, we looked at the following. We tried to define what bookkeeping is, we defined what accounting is, and we looked at double entry, we looked at transaction in the business, we looked at the ledgers, we looked at the journals. So just a recap of what we covered last time before we continue. We looked at accounting. We said financial accounting, it is the recording, classifying, analyzing financial accounting information. So you cannot do accounting unless you know how to do what you call bookkeeping. Bookkeeping is just basically recording the financial accounts in the books of accounts, and therefore we define accounting as the process of recording, classifying, and reporting of financial accounting information. Now we also looked at the users of financial accounting information. Who are those that use financial accounting information? We looked at those ones, and we said we have basically the internal and external. So the internal one includes the owners, the managers of the business, and also the shareholders of every given company. So we have the owners, the investors, and the shareholders of the company. We also looked at the external. External include those customers, the competitors. We also say that the financial institutions like banks will look at the books for accounting before they award you or they give you a loan. We also looked at the suppliers of given goods to the company. They also look at the financial accounting information. And basically, that's what we covered about the users of financial accounting information. We also looked at the basic accounting equation, where we said the assets equals to capital plus liabilities of a business. So if you have the assets, we get the assets by taking the capital plus liabilities. Now, the assets, we said, they are divided into fixed assets and current assets. And we said last time that the fixed assets, these are assets that are not easily converted into cash. Examples of fixed assets, we have land and buildings, we have furniture and fittings, we have premises, we have motor vehicle. All those ones are examples of fixed assets. We also have the category of assets also divided called current assets. Current assets, when you have the abbreviation of CA, meaning current assets. We also have these ones like inventories for business. We mean the stock. We also talked about the cash at bank and cash in hand. Then we also say that prepayments and also the debtors. All these are examples of current assets. So assets are divided into fixed assets, current assets. Fixed assets, we say these are assets that are not easily convertible into cash. And then current assets, these are assets that are easily converted into cash. So we have the fixed assets and current assets. Now, we also looked at liabilities. Liabilities of a business, they are also divided into two. We have long-term liabilities and we have short-term liabilities. Long-term liabilities and short-term liabilities. So the long-term liabilities are these liabilities that take more than 1 year to be paid back. The only example we have about long-term liability is a bank loan. A bank loan is an example of long-term liability. Why? Because if you take a loan from the bank, it will take you more than 1 year to be paid back. We also have short-term liabilities. Short-term liabilities, these are liabilities that are paid back within a period of just 1 year. And therefore, examples of short-term liabilities, we have creditors, or sometimes we call them accounts payables. Creditors also known as accounts payables. And these ones take very short time to be paid back by the business. Then another example we have is bank overdraft. Bank overdraft, these are loans. These are short-term loans taken by the business men and women when running a business. So this is money withdrawn the business over and above your savings in the account. They're called bank overdraft. So I've said shortly that we have the fixed assets, current assets. We also have the long-term liabilities and also have short-term liabilities. And examples, we have looked at those ones. And therefore we can say the accounting equation is given by the following. Assets is equals to capital plus liabilities. Now, we also looked at journals. Basically, what are journals? These are books of original entry, or the prime books in a business, where we record the initial transaction in a business. Journals. So we have two types of journals. We have, we have the main journals here. We have the sales journals. We also have purchases journals. We can also have return inwards journals. We also have return outwards journals. So if you try to define what sales journals are, these are journals that record goods sold on credit only. And therefore, we cannot record anything on cash in journals. We only record the credit transactions. Anything you sold on credit is what you record in the sales journal. So sales journals record only those sales made on credit. We have the purchase journals here. These ones record the purchases made on credit only. Then we have the return inwards journals. This one is also known as sales returns. Why? We record the goods that we sold the customers, but the customer returned back to the business. These are goods we sold the customers, but the customers returned back in the business. They are called return inwards or sales returns. And then we have return outwards. These are books where we record goods we purchase from suppliers, but we return back them. For example, you can buy something from a supplier, you reach home, that thing is not the right quality or it's in excess. You return them back to suppliers. And therefore, those goods returned back to suppliers are returned outwards. Those goods returned back in the business by the customers are known as return inwards. And therefore, we can look at the format of this journal. Okay, I want us to look at the format of the sales journal. Now, I've said sales journal is a journal where we record the sales made on credit only. So we have the format of a sales journal. Sometimes we call them, can call them daybook, sales daybook. When I say sales daybook, it's good to know that sales daybook is the same as saying sales journal. Sales journal, sales daybook is the same thing. So the format, we will have the date, the details, the folio. Folio is the page number of the book. Then we have the amount. This is just a recap of what we covered last time. We said we have those ones. So basically, this is how the sales daybook looks like. Assuming we sold goods, assuming that we have an example here on 1st of June, 2019, the following took place. One, sold goods on credit to Juma, 1,000 shillings. Let me say 1,000 pounds. 1,000 pounds. So how do you record this in the sales journal? You just come and say this is date June, 1st of June 2019. You sold goods to Juma. So details is Juma. We assume Juma is sales ledger number. So you can say SL. SL meaning sales ledger. You can say 001. Then you can record the amount was 1,000 pounds. So assume again we saw we had credit sales to Sarah, maybe 100 pounds. 100 pounds. So we also sold goods. This was on 2nd of June. You can come and say 2nd of June 2019. We are selling goods to Sarah. Sarah is SL002. The amount is 100 pounds. So at the end of the day, we can close down our sales day book or our sales journal by just adding up the total, and we say it is 1,100 pounds. So this is how we prepare the sales journal. You can also look at how we can prepare pack sales journals. So we have the date, the details, folio, amount. And we say that a package journal is a book where we record the goods purchased, anything we purchased on credit only. So we assume this May 2019, the following transaction took place. This is on 1st May. Purchased goods on credit. From Salim. This was about 3,000 pounds. Then that of May, credit purchases from John, assuming is 2,000 pounds. So how do you record this in the package journals? So prepare the relevant journal. For this case, we are going to prepare the package journal. So we are going to record all the goods we purchased on credit only here. So we shall come and maintain the same thing, that this was May, 1st of May 2019. We purchased goods from Salim. Salim is PL001. PL means purchase ledger 001. So the amount here is 3,000. Of course, these are pounds. 3,000. Then again on that of May 2019, we purchased goods credit purchases from John. So we have John and it's PL002, or we can say 003 in that case, and the amount is 2,000. So we get the total. We close down our purchase ledger book by just summing up this, and we say this is 5,000. So that's how we prepare the purchase journal. The other name for purchase journal is sales day. It's also called purchase daybook. Purchase daybook. Purchase daybook. So we record anything on credit in the journals. Only credit. We don't record anything on cash. So we have return inwards, daybook. Sometimes we can call it sales returns. Sales returns book, daybook. The format of this one, the same, we have date, details, folio, and then we have the amount. Now, this book here, sales returns daybook or return inwards, is a book where we record goods returned back in the business by our customers. Goods returned back in the business by our customers. We assume that one of the customers we sold goods to on credit. For example, this was May 5th of May 2019. We had sold goods to Juma. If you remember our sales journal, we had sold goods to Juma. Assume we had sold goods to Juma at 1,000. Then Juma returns back some of the goods in the business. For this case, we will have, for example, let me say e.g. on 5th May, Juma returned some of the goods back in the business worth 500 pounds. 500 pounds. So Juma is returning back some of the goods we sold to him. We say this one we're recording the goods that are returned back in the business. So for this case, Juma is returning some of the goods we had sold on credit to him. And therefore the business is the goods are returning back to the business. In this case, those goods, we record them in a book called Sales Return Daybook. So we shall say on 5th of May 2019, goods returned back in the business here, we have Juma, and the folio of Juma is SL001. The amount returned is 500. So at the end of the day, we'll have the total 500 here. Total 500. So we only record goods returned back in the business by the customers in a book called Return Inward Daybook. Returns Inwards Daybook. The last but not least, we have Return Outwards book. Return Outwards. Return Outwards. Outwards Daybook. Also known as purchases returns, because these are purchases, these are goods we purchase from suppliers, but the business returns back to the suppliers. So the reasons are maybe they are in excess, they are poor quality, or they are the right amount we required. So if we return back the business, the goods back to the business or the suppliers, we record in a book called Return Outwards. So the details, the same format here. We have the same format, amount. Let's assume that we returned some of the goods to Sarah. Sarah was our creditor. Let's assume that we was our supplier. Returned some of the goods to supplier, and one of them is Sarah. Sarah, let me say on 3rd of June 2019, we can say Sarah returned some of the goods to the supplier worth 100 pounds. So in this case, we just come here and record them in the purchase returns book, where we say this was 3rd of June 2019. The details are Sarah, and Sarah was PL003, and the amount is 100 pounds. So at the end of the day, we sum everything that was recorded in the package day book, and we get the answer as 100 total. So basically, this is how we prepare. We prepare our journals for this case. And now the last thing is we have what we call general journals. General journals. The last one we have general journals. These are journals that record anything else that could not be recorded neither in the sales daybook, package daybook, return inwards daybook, or returns outwards daybook. Anything else that we cannot record. For example, e.g., purchased motor vehicle, worth 30,000 pounds on cash. This one we cannot record them. We cannot record it in the journals because they are not bought on credit. For this case, we'll open up a journal, a ledger, which looks like this. We'll have motor vehicle, account, DR, CR. We'll have cash, account, CR, DR. DR means debit, CR means credit. DR means credit, debit, and CR means credit. So for this case, we purchased. So we shall debit the motor vehicle account because it's increasing. We shall debit and we say cash, 30,000. And we shall say motor vehicle, 30,000. For this case, we took cash to buy what? A motor vehicle. So we debit the asset account, which is motor vehicle, and we credit the cash account with the same. So general journals are used to record anything else that cannot be recorded either in the sales journals, package journals, return inwards, or return outwards. So that's how we can look at journals for this case. Then we looked at ledgers. A ledger can be defined as a book where we record business accounts. This is where we record business accounts. A ledger is defined as a book where we record business account. So what is an account? An account is the chronological information about a business transaction. For this case, transaction. Or we can say it's a systematic recording of information about a given transaction in the business. Okay? And therefore, we are saying that a ledger is where we record an account, is where an account is kept. So we also have different types of ledgers for this case. We also have different types of ledgers. We have types of ledgers where we have the sales ledgers. We also have purchase ledgers. We have return inwards ledgers. And we also have return outward ledgers. So a ledger has an account. So an account, how does an account look like? An account looks like this. An account has this kind of format. So you have the date, details, and amount. the date, details, and amount. So we have two lines here. These are boundary lines. This side, this left hand side of the account, left hand side of the account is the debit side. Debit side. Sometimes we abbreviate by saying DR. This side, the right hand side of the account, is the credit side, and we abbreviate it by CR. So this is the debit side and this is the credit side of an account. So if you look at this, the left hand side is the debit side, the right hand side is what? The credit side. So we have DR and CR. So an account, so in short, in brief, we don't have to draw everything like this. We just draw an account like this, a T format account. We just say DR and CR, and we have the name of the account. Name of the account. So instead of drawing all this, we just abbreviate all this information into a small account called a T format account. So for this case, we have the date, details, amount, then also have date, details, amount. So this way is debit side, this way is credit side. Now, I want us to learn about how we can enter a transaction in an account. So to be brief enough, we are saying that an account, we can abbreviate it by just having like this, DR and CR. Debit and credit. So what we debit and what we credit. It's very important to know the basics of accounting when it comes to recording a transaction. Accounting is about double entry. Double entry means anything we get in a business, any business transaction, there must be a debit and a credit. A debit means anything you are receiving in the business is debited, and anything you are giving out of the business is credited. So when you are debiting an account, you are increasing the account. When you are crediting, you are decreasing the account. So this side here is the increase side, and this side is decrease side. So there are things you have to know about an account. An account has the name of the transaction being affected. Number two, for every business transaction, there must be two accounts being opened. For every business transaction, there must be two accounts being opened. So for every transaction, you must open two accounts. It is a must. That's why it's called a double entry. It's a principle in accounting, whereby every time there's a transaction in the business, there must be two accounts being opened. For this case, you open 1 and 2. So you open two accounts like that, like that. And then, when you debit one of the accounts, you should credit the other account. In fact, you do the opposite. When you debit, you credit. If you credit, you debit. You cannot debit and debit, or you cannot credit and what? Credit. So this case, anything that is coming in the business, you are debiting. Anything going outside the business, you are crediting. Crediting means decreasing, and debiting means increasing. So every time you are making a transaction for business, there must be two accounts being opened. Number two, when you debit the one of the account, you have to do the opposite of the other account. You credit. Now, also, when you buy an asset, in the business, buy an asset, for example, we can say on 1st of January 2019, bought a motor vehicle. Motor vehicle is a fixed asset. Motor vehicle for 100,000, maybe pounds, on cash. This is a business transaction. We are saying on 1st January 2019, bought a motor vehicle for 100,000 shillings on cash. This is a transaction. We've said for every transaction, you open two accounts. What you do? You open two accounts. That's the first principle. You open two accounts. One account, you call it motor vehicle account. Motor vehicle account, of course, DR, CR. Then the other one is cash account. So there must be two accounts being affected. Here we have the motor vehicle account and the cash account. One of the account is increasing, the other one is decreasing. When you take money from the cash account to buy a motor vehicle, automatically, you can take this in the bank. Automatically, the cash account decreases, And then the asset account, which is the motor vehicle account, will do what? Will increase. So we have taken money from the cash account to buy a motor vehicle. So for this case, the cash account, we shall credit, because when you are decreasing, you credit. So we shall call the the right hand side of the cash account, and we credit. We say motor vehicle. MV means motor vehicle. That is 100,000. For this case, we are taking money from here to buy what? Motor vehicle. And then you come to motor vehicle and we debit with cash 100,000. This is very simple. You just credit the cash account because the cash account is reducing and the motor vehicle account is increasing. Therefore, you take money from the cash. That's why we credit the cash account, and we come to the motor vehicle account. We debit because the motor vehicle account is an asset account increasing. Therefore, it's good to note this, that when we buy an asset, when we increase the asset in a business, we should debit. That's the first point. So every time you buy an asset, you debit. So it's good to know this, that one, every business transaction, two accounts are opened. Number two, we debit, that's DR, or credit the accounts. So we cannot debit and debit. We debit and credit. And when we credit, we do what? We debit accounts. Then number three, when we increase the assets in a business, we debit. Number four, all sales, if we sell anything, all sales are credited in the accounts. All sales, e.g., we can say e.g., sold goods to Amina, 200 pounds. We sold goods to Amina, 200 pounds. We are saying all sales you credit. So we have said again, the principles remain. Every business transaction, we open two accounts. For this case here, we shall open two accounts. We have two accounts here being opened. The account is sales, and the other one is Amina. Amina is an account. So you have the DR, you have CR, you have DR, you have CR. This is the sales account, and this is Amina account. Now we are selling goods to Amina. This word two is going to Amina. Amina is receiving goods. The receiving account will always debit. So we shall debit Amina. Sales 200. Sales account is losing goods to Amina. So we shall create what? Sales account to Amina. This is very simple. It means every time we sell anything in a business, sales account is always credited. Never debit sales account, and never credit purchase account. Number five, now we can now say that we have now all purchases in a business, are debited. Whether we purchase anything on credit or on cash, we always debit purchase account. The principles remain. Two accounts are opened, e.g., you can say e.g., purchased goods for 200 pounds. Purchased goods for 200 pounds from, say, Charles. We had purchased goods from Charles, 200. So always open two accounts. Always, please remember this. Always to open two accounts. Double entry. We have purchases account and we have Charles account. Why? Because we are purchasing goods from. The word from. Charles is losing, Pak's account is gaining. So Pak says you debit with Charles 200. We come to Charles' account and we credit with Pak says 200. As simple as that. So we have the debit side, credit side, we have debit side and credit side. And therefore, we can conclude that Pak's account, all of them, when you purchase anything in the business, Pak's account is always debited because it increases. Whereas sales account, we credit because sales account decreases. Another point here, number 6, is all expenses in a business, all expenses, e.g., salary is an expense, electricity is an expense, insurance, and etc. There are many expenses. All expenses in account are debited. Why? Because when you're paying an expense, you open the expense account. That expense account is increasing because it's receiving some payment. For example, e.g., we can say paid salary $10,000 paid by cash or by check. By check. When you say by check, means we are taking from the bank. So we always have to open, these are transactions, the same principles remain. We open 2 accounts. We open 2 accounts here. The first account is salary account, and this is an expense account. And the money is coming from somewhere. Check means bank. So we have the salary account and have bank account. So the bank account is reducing because we are taking money from the bank to pay salary. And the salary account is an expense account, is increasing. The increasing account we always debit. So we come here and debit salary account because it's an expense account. As you have said that all expenses are all debited. So we come here and debit, we say bank, that is how much? 10,000. Of course, dollars, pounds. And then we also have bank account. We are taking money to pay salary, which is, so it becomes very simple for you because someone will ask what's happening here. What's happening is that we are taking money from the bank account to pay salary. So the bank account is decreasing and the salary account is increasing. So every time we are increasing the account, we debit. Every time we are decreasing account, you credit for that case. So those are the things that you should know about this. Then it's easy for us to now work on ledgers. So after opening the journals, you can transfer what was in the journals into the ledgers. For example, we can remember the names of those journals. We had Juma, we had Sarah, we had Charles. So if you open the accounts for these guys, you just come and say, for example, for Juma, you open like this, you write Juma account, DR, CR. You also come to Sarah and open an account called Sarah account, CR, DR. We also had sales account, like that, CR, DR. We also have Pak's account, sales account, we have account, we have DR and CR. So for this case, this is how ledgers look like. Ledgers, they look like this, which are a group of accounts. Now, if you look at Juma, you look at Sarah, you look at sales, you look at purchases. Juma is affecting sales and Sarah is affecting purchases. That's why you say for every account, for every transaction, there must be 2 accounts. For this case, we have Juma and sales. Assume that Juma bought goods. Bought goods from the sales account. Let me say that we sold goods to Juma, 100 shillings. We just come and say Juma is receiving goods from sales account. Come and say sales 100. 100 pounds. We come to sales account and credit and say Juma, 100 pounds. We assume that Sarah is affecting purchases. So purchase account, we are purchasing goods from Sarah. Automatically, the purchase account is increasing, the Sarah account is decreasing because we are buying goods from Sarah. So come and debit our purchase account with Sarah. Let me assume it's 200 pounds. We come to Sarah account and say we are crediting from her with purchases, 200 pounds. So this is what we covered last time about ledgers and journals. It's also very important to know how to closing down the ledgers. How do you close down the ledgers for this case? E.g., we can say sold goods to Juma, 300 pounds. Then this one, number 2, can say purchased goods worth 200 pounds from Mary. Then lastly, paid salary worth 3,000 pounds. Then number 4 can say also sold goods to Jerry, 800 pounds. So in this case, you are told post the following into relevant ledger accounts. You are told to post the following information into relevant ledger account. The first one is sold goods to Juma, 300, purchased goods worth 200 pounds from Mary, paid salary worth 3,000, then sold goods to Jerry, 800 pounds. So you are told post the following into relevant accounts. Our principles remain. We open the 2 accounts like this. So, for example, the first one, sold goods to Juma. We have Juma account, and we also have sales account. Very easy. Our principle number 3, we said all sales you credit. So you come to credit account and credit with Juma, 300, and Juma is gaining from sales. You say sales, 300. You come to number 2, you also open another account, 2 accounts again. You open purchases account and Mary account. So purchase account, DR, CR. So purchase account you debit because we said all purchases you debit. You say from Mary, that's Mary, 200, and this is Mary is selling goods to. So purchases account 200. So for this case, you also have paid salary. So before you go to number 3 and number 4, we can look at number 4 because it's also sold. So you can skip number 3, cover number 4. They're saying sold goods to Jerry, 800. So instead of opening another account called sales and Jerry, you already have sales account. So the only account you open here is a new account called Jerry because we already have sales account. You don't open many accounts if already the account has been opened. So sold goods to Jerry, 800. So the only account I open is Jerry account, For this case, open Jerry account maybe here, just in between here, Jerry account. Now we sold goods to Jerry. Just come to Jerry account and say sales 800, and come to sales account and say Jerry, because you already have the account for sales 800. Now, how to close these accounts? How to close these accounts? Let us see how we can close these accounts. Let us see how we can close this account. Let me transfer them up here. Now, we have the sales account. Sales account. For this case, we had Juma and we had Jerry. Juma is 300, Jerry is 800. So we want to close this account here. How to close down? You make a line here, you add this plus this, you get 1100. You come again, you put this 1100. You close like that. Now, this side, we say balance carried down. This one is balance carried down. This one means balance carried down. The balance you're closing the year with. So balance carried down will be 1100. Then, when you put balance carried down this way you put balance brought down, which is 1100. So this is the closing balance and this is the opening balance. The closing balance is called balance carried down. The opening balance is called balance brought down. Let us pick another account. Let's pick the account of paid salary. So we have salary account. Salary account. Assume we paid salary to Juma. So we had Juma account. And we paid salary Juma. We paid salary by cash. We took cash to pay salary. We are paying salary cash to salary. Let me say 10,000 pounds. And then we're saying cash 10,000 pounds. How to close this account? This one, 10,000 pounds. This one we just close. We say total this way. Total is 10,000, of course. Then the total this way is also 10,000. So balance carried down will come this way. Balance carried down 10,000. Then balance brought down will come this way 10,000, like that. So we have cash account here. We can also close that one. We can say balance carried down is 10,000. The total is 10,000 still. 10,000 still. So balance brought down will be 10,000. That's how you close down any account. You always close account. Don't leave account open. Every account should be closed.